Sanjay Mookim joins us, India head of equity research. He is going to walk us India head of equity research with JP Morgan. So nice to have you back. Thank you for joining us. Let's
Pleasure.
Let's understand where are we in terms of the earnings cycle. We started the year with the assumption that FY23 would be a good year. Now as we roll over from the first half of this year to the second half of this year, inflation is high, earning downgrades are visible, central bankers are increasing rates. Are we in for a tough second half after a choppy first half?
Well, look, as they say, beauty is in the eye of the beholder. So it depends upon which sector you're looking at. The metals companies, for example, have seen significant upgrades to their numbers, and justifiably so. And despite the measures that may have happened over the weekend, it is the implied forecast for metals might still be vulnerable to some upgrades. Banks, we don't see too much risk to earnings ourselves, but it's mostly the domestic-facing consumer staples, discretionary, where expectations appear high and vulnerable to earnings downgrades still. So it's a mix and match. You can't uniformly apply the downgrade backs to everything in the market, to my mind. But when you are in India, you're in India for the domestic long-term consumer story. And unfortunately, that is the pack that is currently hurt the most by this uncertain macro.
Sanjay, for markets to bottom out, I'm using two very elementary data points here. Two things have to happen. Either valuations have to become attractive, which is what happened in 2020. We bottomed out at the peak of COVID crisis. Or the central banks have to help you. Unfortunately, both those factors are not there. Central bankers are moving against you, which is the increasing rates. And I'm asking a longer question for the benefit of our viewers. Or valuations have to reach at throwaway levels. So right now also as we speak, after a 15% correction, Nifty is still above its 10-year average. So why will markets bottom out then, if both the factors are missing?
No, you're exactly right. So if somebody is looking to time the market, there needs to be a catalyst. I would put the valuation criteria probably secondary, and very simply because valuations are known to undershoot as well. If you are in the midst of a crisis, we've had indices at 12 times or even less earnings. So on a timing question, you need a catalyst. And if you think through what's going on in the world at the moment, there are two or three major events. One, of course, is the war in Eastern Europe and the geopolitical uncertainty it brings, the supply chain disruptions that it causes. If that is to be ring-fenced, or if that de-escalates, that could be a major event that provides some support. The reopening of the Chinese economy is something that is now underway, and hopefully that provides some stability to outlook and demand in the Asian region. But the most important point, as you highlighted yourself, will be the tone of central banks on monetary policy. If you get continued hawkishness from central banks, continued guidance to liquidity withdrawal and rate increases, I don't think asset prices will find a bottom so soon.
Sanjay, I think what everyone really needs to know, or rather knows, is that the one devil out there is inflation. And, that's why you're getting chopped and churned from every corner. How is it that you inflation-proof your portfolio? What should be your underweight and overweights right now?
Well, if you answer that very technically and you look at how sectors in India have behaved during such periods when oil prices are rising or when interest rates are rising in India, the behavior of sectors suggests that banks tend to underperform, and sectors such as IT, staples, and healthcare, the traditional defensives as they're known through intuition, empirically these are sectors that have outperformed the market in periods of inflation. Now, does it mean that you have asset price protection? Does it mean that you will not have downside to these? No. This is a relative positioning argument. As an asset class, equity will come under pressure as a whole when rates are rising and inflation is a problem.
Where does good old IT fit in? The bullish cases, they're growing. The bearish cases, US is now contracting.
Well, look, I'm not really sure that the US is contracting. The better way to put it, perhaps, is to say that growth rates are falling. The US is still growing, albeit at a smaller pace, to our mind. We have ourselves downgraded a bunch of IT companies last week, and our argument is twofold. One, that valuations still remain slightly higher than they have been historically. Now, yes, they were more expensive in the beginning of January. They are less expensive now, but there is probably still some room on the downside on valuations. And our concern is that the growth rates these companies have delivered during COVID, but probably the best rates that they've had in several years, these are now going to decelerate, partly under their own weight and partly because, like you said, the outlook of the US economy is deteriorating. So when you see companies, stocks with above average valuations and possibly growth downgrades and margin downgrades, then it's unlikely that that sector will work too much relative to the market. And that's the reason that we have a slightly neutral negative bias on IT in our recommendations.
Interesting. You know, the other thing, Sanjay, I wanted to talk about is how is it that you now look at e-com companies? And I know you can't talk stocks, but I can, so I will mention. I mean, you know, delivery, for instance, and Nikunj and I were just chatting about it. Nykaa, Paytm, yes, don't have peers, but delivery sure does, right? But then also you've seen a nice premium listing even in this current market environment. Look at Zomato, Paytm. They also, from those oversold levels, have made a bit of a comeback. And, you know, these companies are now slowly getting a lot more cost conscious. And I think that also is something that the market is sort of, you know, keeping an eye out on. Get back to these names. Do you think the selling has been overdone?
Okay, let me not provide recommendations
Sure.
stock as you know, I'm prohibited from doing that. But what I would argue is that, and we've done a lot of work on this, we did a note on Friday as well highlighting that there is a lot of upside to consumer activity in India, right? You can no way argue that we are fully penetrated on any category in the country, and especially the new age consumption baskets have a multi-year runway for growth, right? And I don't think that there is too much debate around that. And if you have one of these companies, probably will succeed in becoming much bigger over a 10-year time frame, will probably end up generating cash flows as expected or probably more. But the mode of investment in such stocks will therefore have to be with a long-term mindset, right? And the disconnect I see with the clients is that, look, I bought it for the long-term promise of the economy, but then I expect stock returns in 3 months or 6 months. And that's the disconnect that I see in these new age economy stocks. They are probably still suited for a private equity mindset in my mind.
Sanjay Mookim, good morning. You said that, last week you downgraded some IT stocks. You've anyway been underweight when it comes to the consumer pack and neutral on staples. So what is it for Sanjay Mookim and JP Morgan? Banks, banks and banks?
Well, banks do make sense still fundamentally on earnings outlook and on valuations. But the one change that we have made to our portfolio is we are now overweight staples, right? And the reason to do this was twofold, frankly. We are seeing a significant tailwind to rural income in the form of rising agri prices. We've done a lot of math behind this, and it's not just one or two commodities, but a vast basket of agri prices are moving up. There will be some cost inflation for Indian farmers, but not sufficient enough to cancel the revenue upside in my mind. This is not played out yet because the cash flow to farmers happens when when the crops are harvested and the realization will come in a couple of months. So we do expect that in a few months you will see increased activity, increased momentum in parts of rural India, with the caveat that this is not driving GDP growth. This is essentially a transfer from an urban consumer to a rural producer. And secondly, of course, you had some of the rural sectors such as staples underperform the market significantly, with companies kind of throwing in the towels where expectations were reset. So tactically, from a sector positioning plus a tailwind from rural income improvement, we are now actually overweight staples. So our two overweights in our portfolio are banks and staples right now.
Okay, so you're going overweight in banks, you're going overweight in staples, but you will stay underweight on consumer stocks. We have seen that the consumer stocks have been performing. Earning forecasts are also talking about a good revival.
Our job, right? Whether we believe those earnings forecasts or not, and we don't, right? And the reason for this is twofold. One, inflation is a problem. If you look at data in the country going back a decade more, invariably inflation hurts volumes of discretionary and durable consumption, right? It does not affect staples demand as much. That's what the data says. And as the price increases happen, what we've seen in the last 2 quarters is every company's passed it through. saying that, look, I have input cost increases, I'm going to raise my prices and protect my margins. There is no free lunch, as they say in economics. The raising prices, they will impact consumer demand, and I therefore believe that the earnings forecast people have presented are at risk. And the second problem for several of the discretionary companies, for example, is valuations. Many of these are trading at a premium to where they were even in December 19. You forget long-term averages. Just the pre-COVID multiple has moved up a lot, and the whole world is normalizing. The economy is going back to pre-COVID, rates are back to pre-COVID. Why should these companies sustain a premium because of COVID? It does not make sense. So you have a combination of earnings vulnerabilities, a combination of valuation issues, and we are very emphatically underweight some of the discretionary things.
But will banks do well when you have a challenge of treasury income? Inflationary pressures, if they come down, working capital requirement will also come down. It may delay companies to even delay their capex, and term loans will also get challenged. While the balance sheet may be clean, but the credit offtake numbers are not looking impressive.
Yes, and that's the hope trade, right? And there are two reasons to look for credit growth in the country. One is nominal inflation, as you said it yourself, right? Banks are nominal instruments, and whether it is through real activity or inflation, you could see credit demand move. And our view is that Indian banks are not value stocks. Globally, banks are treated in the value basket. Indian banks are firmly in the growth category because we pay these multiples for Indian financials in the scope of double-digit sustained growth. So if you are able to deliver growth while balance sheets remain healthy, as you said, you should be able to drive that compounding book value growth and therefore stock return year after year. In the early phases of rate cycles, banks benefit because NIMs expand and loan growth is not hurt. But if you do see persistent increases in rates and big handle changes in interest rates, then you might start to worry about loan growth. We are not worried about it just yet.
Sanjay Mookim, really appreciate your time. So glad you could join us.